Good everyone, how are you going? Phil Tarrant here. I am the Executive Editor of Real Estate at Momentum Media, and you may know me as the host of the Smart Property Investment Show. Thanks for joining us for Smart Property Investment Live. Really enjoy doing these. It's really an opportunity for us to do a deep dive look at issues, challenges, opportunities, property right across the nation. So expect to see more of us doing this stuff. I apologise in advance. You're going to see my face. Might not be the best thing to look at. I'm much better head for audio rather than video, but it's a great opportunity for us to bring in people from right across the nation to chat about those key issues driving property markets. Today is going to be an hour of power. We've got a great guest in the studio to come and chat with us, not just about every single state. We're going to talk specifically about Queensland and especially about Brisbane, which is a property market which, if you listen to the Smart Property Investment Show, I invest in. I've got a number of properties up there, and like a lot of property investors have been waiting for this spark of growth that's going to be happening in Brisbane. So we're going to get into that today. We're going to be talking about my portfolio. We're going to talk about suburbs, opportunities, economic drivers, the government, a whole bunch of things up in Brisbane, and I'm saying up because I'm down in Sydney, that are influencing property markets up there. It's way outside my pay grade. I use experts to help me invest in Queensland because it's not my area of specialisation, and my role here as executive editor is to be the curator and aggregator of information to get the best people into the studio for us to have a chat about these different property markets. Today, that's Melinda Jennison. She is the founder, one of the leaders there at Streamline Property Buyers. Melinda, recording from Brizzy, from your home studio, social distancing. How are you going?
I'm very well, thanks for having me, Phil. Yes, from home up in sunny Brisbane, although today not quite so sunny, a bit of cloud cover, but warm as it always is.
Very good. So we're recording this, and because it is live, I can actually timestamp it.
Yep.
I normally get in a lot of trouble when from our broadcast team here that I actually frame something, and if we release it a couple of days later, people know, but this is a live stream. It's a live broadcast. Already I've got questions coming in on my my iPad here. There we go that way. Of property investors right across the nation wanting to ask you questions. But as the host, I get the privilege of asking you questions first, so I get to steer this ship. But what I'll be doing over the course of the next hour, Melinda, is that I'll lean on some of these different questions as they come through. I'll look for themes that we can draw on in order to spark this conversation, get us directed in the right way. I know you're a proud Queenslander. You've lived in Brisbane for many, many years, and for those of our viewers and those who also listen to the podcast, we had a really good chat last week about your investment journey, which I really enjoyed. It was great to get the backstory for how you ended up passionate about property and why you do what you do now.
Yeah, it's not something that we share often. We don't like talking about our personal portfolio, but a lot of people do ask us that question when they reach out to us. So we felt that, the best way to help people understand what we do and how we can help them is to share our own story. And what we did disclose is how we've used the power of manufacturing equity to build our own property portfolio. And whilst our portfolio is just in Brisbane, we have diversified through asset class, so looking at commercial as well as residential property, and also through strategy, that is renovation and development. So it's been quite a journey for us, and what we do now is help other people to take a similar journey or set themselves up for their future.
And as we spoke about on the podcast, and by the way, I really enjoyed you being so frank and honest with your portfolio. I know you and Scott don't normally share it very often, so I imagine a lot of your clients are probably going, wow, now I actually know the real story, and isn't that pretty interesting? But much like you, my portfolio, the Smart Property Investment portfolio, a lot of it's been driven by manufacturing equity. So we'll have a chat today about those type of opportunities in the Brisbane market. But for our viewers right now, a couple of objectives that we want to cover off. If we get this nailed, I think we're doing a pretty good job, Melinda. I want you to be, where you can, share what's happening up in Brisbane. So this is a deep dive into the Brisbane market. For all those people who say, I don't invest in Brisbane, they might be switching off right now, but the best investors I know are always looking for diversification and thinking outside of where they would traditionally invest. So we'll have a chat about that. What I'd also like to articulate is that Brisbane is not just one market. There's a lot of different markets up in Brizzy, and we're going to get down to the suburb level with this particular chat. What I also want to get you to articulate is that the drivers and nuances of the Brisbane market is often quite different to what people might be used to in Sydney and in Melbourne. And especially this this particular live broadcast is driven. It's Brisbane off the back of COVID-19. So we're not just having this discussion about Brisbane in isolation. We all know as a nation, as a globe, as people, what we've gone through over the last 3 months with COVID-19. So this conversation is going to be focused on property markets and the property market in Brisbane coming out of COVID-19. The last big hiccup or hurdle for Brisbane property market, by memory, would have been the big floods. And that changed the way a lot of people invested in Brisbane. So that was a watershed moment for Brisbane. And again, to the point, Brisbane is different to other to other cities in regards to some of these unique drivers, but we'll be really, really specific about COVID-19. Let's kick off at the top. Brisbane versus Sydney and Melbourne. This is the stuff that makes great content on smartpropertyinvestment.com.au. Why Brisbane over Sydney and Melbourne, Melinda?
Yeah, it's a very good question. And I think that there's a lot of drivers that property investors have in Brisbane that don't align with what Sydney and Melbourne investors have. So the biggest right now is affordability. So the median price in Brisbane is about 56% of the median value of Sydney properties, and it's about 75% of the value of Melbourne properties. So when it comes to purchasing an investment property, the amount that you pay to get into that, obviously, drives the type of investment that you can follow. And then from there, we talk about strategy and goals and make sure that the property that we're selecting aligns with those other long-term drivers. But that's something I'd like to dive into a little bit later. And I've got some slides to share about significant events in history that help us understand the difference between those markets.
So this point about why the drivers or nuances or the specifics of Brisbane makes it a different market to invest in that Sydney and Melbourne, what are those? And I mentioned the floods, which is a universal impacting consideration for Brisbane. Some areas flood and some areas don't. You don't necessarily get that in Sydney. You don't necessarily get that in Melbourne.
Yeah, river flooding is a significant thing that people need to be aware of when they are buying property in Brisbane. The impact of the 2011 floods was significant. It not only impacted people's lives and their homes, but it impacted our economy in a significant way. So, over the last 10 years, the Brisbane property market has been fairly flat in comparison to what's happened in Sydney and Melbourne. I think on a annual growth capital growth projection, we've had 1.6% per annum average capital growth as a median value. Now, there's definitely some pockets that have outperformed others, which is, what comes down to location selection. But when you look at the comparative increases in people's incomes, we've had 2.5% increase per annum over the same period in income. So Brisbane over the last 10 years has actually become a more affordable market because the the house to income ratio has actually declined. So it simply means that people do have the capacity to purchase. We've got much higher borrowing capacity now, and with credit at the cheapest that it's ever been. It also helps people to position themselves for a home or an investment here in Brisbane without the high leverage that is required to purchase into other markets around Australia.
So we're having this discussion, Melinda, and I think it's safe to say now that we're coming out of COVID-19. I know down here in Sydney, schools have been back for a couple of weeks now. You can get 50 people. There's no restrictions, I think, starting 1 July on indoor venues. As long as you've got 4 square metres per person, you can jam as many people into a pub or a restaurant as possible. So that's all really good. Festivals allowed now. You're allowed to get out. You're allowed to have 20 people in your own house, etc. So I think we're through the depths of COVID-19 and acknowledgement, irrespective of where you sit on the political spectrum, acknowledgement to the government, the federal government, for how they've navigated it. And we've done pretty well from a health crisis point of view. And now each state has its own different ways in which it's approaching it. Queensland's been locked up. Hasn't wanted us southerners coming up there. That's now, from what I understand, been relaxed. How much of an impact has COVID-19 been on the Brisbane property market? Is it too early to tell?
Yeah, it's a very good question. And I think to put that into perspective, what I would like people today to understand, and if we can bring up the first slide, it will help people understand what or what the number of cases looked like in Queensland in comparison to some other states. So here you'll see, we're all very familiar with these curves now. These are the number of cases in Queensland. Now, I've highlighted a very specific date there, being April the 5th, because on that date and every day since then, Queensland has had less than 14 cases per day. And in fact, we've been running on zero community transmission for a number of weeks. So any recent individual cases have been cases that have been brought in, either flown in from interstate or brought in from overseas. So that gives people perspective. Even at the highest peak of our curve, we had less than 80 cases in a day. If we look at the next slide, this helps people also understand the number of cases per 100,000 residents. So Queensland there is the dark blue line, second from the bottom. Again, I've just pointed out that point in time, April the 5th, 2020, where we actually flattened the curve. And what you'll see by this graph is that the number of cases in Queensland as a percentage of our overall population, we've performed the second best, if you like, out of all of the states here in Australia. So that gives some perspective in terms of the way we've tackled the virus. Obviously, what people want to understand is what impact has this had on property markets. Now, clearly there were, with social distancing rules that were put in place, then we had some limitations on the number of people that could attend open homes. Then open homes were cancelled, auctions were cancelled. There's been some significant impact in the real estate market. But what we've noticed mostly is that transaction volumes have decreased. So here in Brisbane, the transaction volume decreased by 40%. Now compare that with the national average of 45%. And again, not as bad, but still pretty low volumes of sales. And I think that what we need to understand then is has that had any impact on the values that people have achieved when they've had to sell? Now, I'm not going to lie, it was actually a pretty scary time when we were in the worst of the pandemic towards late March, early April. And what we found, like we even had clients at that time that were settling on properties. We'd purchased them 1 or 2 months earlier and their settlement was due at that time. So, you know, we had genuine concern, not whether they'd settle, but whether they'd actually find a tenant, because Queensland had introduced some pretty crazy tenancy laws and things like that. So we were unsure at that point in time whether whether we could actually get a tenant, and if we did get a tenant, whether that tenant would actually stay in place as well. But thankfully, the Queensland government introduced laws that were fair for both landlords and tenants. And the properties that we had settling, none of them took longer than 2.5 weeks to find a quality tenant. So despite what some of the headlines were telling us, and despite what some of those news headlines were showing, good investment grade properties were able to secure tenants fairly quickly. One thing that we did notice is that there's been some changes. Let's have a look at I've got a slide on what's happened to property values, which is something that people are very interested in. Here's the latest CoreLogic data up until the end of May. Now, you may have seen headlines again saying Brisbane property values declined negative 0.1%, which is actually what this shows as well. Dwellings are grouped as one, whether they're houses or units. So I think it's really important for people to understand what's happening in the housing market versus what's happening in the unit market, because they're very different markets here in Brisbane. So if we have a look at the housing market, our houses are at the highest level ever. So our median housing values have never been higher right now. But the median unit value has declined from its peaks. So if we have a look at the next slide, it's going to show us the percentile changes in terms of price growth that we've seen here in Brisbane. So again, looking up until the end of May 2020, I've just circled the data that's relevant to Brisbane. We saw greater price decreases in the lower quartile of the price point. That was negative 3% growth. No change in the middle ring and the 50th percentile, and just negative 1% change in the upper percentile, the upper 25th percentile. And there's one more slide that helps to explain this data. Now, obviously I've got a research background, so I like to understand all of this data, and I like to understand what the data is made up of. So when we look at dwelling values, which have declined negative 0.1% here in Brisbane, we look at the housing market and it's remained flat. But we look at the unit market and it came off negative 0.6% over the month. So it's actually so important that you not just understand the superficial numbers, but you dig into those numbers to get a real understanding of what is going on.
So, in summary, Brisbane's not doing too badly.
That's right.
That's my Phil Tarrant economic head. It's as simple as I could explain it. It's not too bad.
Absolutely. From a value perspective, it's not too bad. And obviously different asset classes are going to be performing in different ways. I think it's important to highlight that the rental market has experienced some changes as well. So what we found with our clients that were settling at the end of the pandemic or at the peak of the pandemic period is that they reduced their asking rents to ensure that they could achieve an outcome faster. So we have seen a decline in the rental market in terms of the asking prices. So that potentially has impacted any investors that have a high cash flow strategy and rely on that income to cover the costs of holding that property. So the rent discounting, and I can break that down to a suburb level, between March and April, what we saw is that the suburbs most at risk because of rent discounting were mainly the Brisbane CBD. We saw 24% of all rentals discounted in May compared with 14.9% in February, and that's domain data. So you can see there's a huge difference in that location. East Brisbane is another location that's been most significantly impacted. 15.2% of rent discounting in May versus 8.5% in February. So again, a big spike in that location. And the third location is Milton with a 32.7% peak in rent discounting in May versus 10.3% in February. Other investors are really cautious about monitoring vacancy rates. Obviously, the higher the vacancy rate, the more likely that you are to miss out on achieving your gross rental targets. So you want to ensure your vacancy rates are as low as possible. Some areas of Brisbane have really seen a huge spike in vacancy as well. And it's so important for investors to understand the vacancy rate in an area, not just at a given point in time, but what that trend is over time. So at a city level, when you're looking at Brisbane, the vacancy rate has not changed significantly. In March, it was 2.1%. In April, 2.8%. And then in May, just dropped back down to 2.5%. However, there are some suburbs that have huge vacancy risk right now. And what I would like to say is that generally it's related to the product type and not necessarily the location itself. So, for example, the suburbs at risk because of vacancy are the inner city suburbs of the CBD, Spring Hill, Petrie Terrace. Typically, that's where you've got a lot of high density unit developments. Vacancy in that location went from 5.7% in March, and at the end of May, it's currently at 13.3%. Wow. So we saw a lot of short-term listings come off the Airbnb market, things like that, and they went onto the long-term market as well. So there's huge risk for investors that have purchased that type of stock in that location. 3 other suburbs, very similar types of properties and very similar demographic of people that occupy those properties. We've got West End and Highgate Hill, went from 4.1% vacancy in March, peaked at 9.1% in May. Newstead, again, a lot of high density unit developments. In March, 3.8%, by May, 7.7%. And the last one, Hurston, that's very close to the Kelvin Grove Queensland University of Technology campus. So a lot of student accommodation. In March, 3.4% vacancy, and that peaked in May at 7.7%. So it's so important to understand the locations. And also, if you are in an area where you've got a lot of high density unit development around you, that does peak in these periods in terms of vacancy, it can have a run-on impact into the housing market in those surrounding locations. So it's definitely something as an investor that you need to be aware of.
Okay, so lots of information there, and I think go and check out smartpropertyinvestment.com.au. We'll get Melinda to provide some of these slides, and as a property investor myself, there's a whole bunch of different metrics that I keep an eye on just to make sure I can understand the performance of my investments, but also shape the way in which I invest in the future. And vacancy rates, considering COVID-19, it's going to be something which is going to be impacting all areas into the future. So keep right across that. Now, Melinda, let's go to some questions. And I like leaning on our listeners to help shape the conversation. So get involved, ask anything. Well, ask Melinda anything. You can't ask me anything. I was going, I don't know. You'd ask Melinda, but ask us anything. Just wherever you're watching this right now, you'll see the little box next to it called Slido. You just put your question in there. You can be anonymous if you want. We'd like names, that's better, but and send it over and we can get them answered. Now, this is, you always see this, people are always asking for hotspots, right? Where do I invest next? So before we go there, Melinda, I'd just like a bit of an idea or a bit of an insight into your philosophy towards property investment. Now, you spoke about your own journey in the podcast, and it was about manufacturing equity. So being able to identify properties where there is some upside benefit and value, and that's one way that you shape your investment decision making. Other people do it in different ways. So in terms of when we're talking about hotspots, a lot of that's going to be shaped by the way in which you invest, or the way in which you support your clients to invest, or your philosophy towards investing. So how would you summarise that, just to give us somewhere to start from when we start talking about particular suburbs?
Yeah, it's a great question, and it does come down to what an investor's trying to achieve over the longer term. And when I talk with our clients about building an investment portfolio, I talk about different phases. I talk about the accumulation phase first and foremost. And in that phase, it's actually about building out your asset base. And the fastest way to do that, in my opinion, is to buy properties that have good capital growth potential. Now, for some investors who may be on lower incomes, targeting properties that may not produce or pay for themselves or produce an income is going to be a lot harder. For any investors that are on higher incomes, targeting properties that potentially have the tax advantage of negative gearing, it's going to be easier to hold. So my philosophy is always that investment strategy has to overlay with mortgage strategy and tax strategy. And that's a big part of the planning that we would do with clients, because it's not a one size fits all when it comes to property investing. So we don't have huge agent networks in areas in Greater Brisbane where investors are purely targeting cash flow. And the reason for that is that I do believe that the fastest way to build wealth through property is time in the market and letting the market do the heavy lifting if you've bought in a location that's got great capital growth drivers. So I'm all for helping people to build out their asset base and to ensure that when they're purchasing property today, they're going to achieve the outcomes that they're wanting 20 years from now. It's not about quantity, in my opinion. It's about quality. And, certainly that's the philosophy that I've followed as well. I would rather manage 4 or 5 A-grade investments as opposed to, 10 or 12 B-grade investments, if you like, that are going to potentially attract a different type of tenant as well. So that's a generalisation, and I understand that. But what I like to do is ensure that we're working with clients, that we're matching their tax strategy with their finance strategy, and then fitting the investment strategy in on top of that.
Okay, so it's important we cover that off, because the way in which you go about doing that is going to shape the type of properties that you identify for people, and the way in which is going to suit them depending where they are on their property investment journey. That aside, everyone wants to know about locations. It's just the way the property investment world works. So I'm going to start off with a question here from Talia. And again, we've got to go this, by way of disclaimer, this is just us having a chat about this sort of stuff. So this is not necessarily property investment advice. This is just two people in property having a chat about property investing. So make sure you speak to the right people, your own set of trusted advisors, before you make any property investment or mortgage or tax planning decision. However, Talia asks, what price range would you adhere to when buying an investment in Brisbane right now and within a radius kilometres to the CBD, and what directions? North, south, east, west. So
love this question.
Get yourself a dart and throw it at a dartboard. So to summarise that, what brackets would you be investing in right now, and whereabouts are they?
Yeah, it's a great question. What I would like to say is Brisbane is not a circular city. It's not about radial proximity to the CBD, because as you mentioned earlier, Phil, there's some there's some suburbs that are not far from the CBD that are significantly impacted by flood, and they are not investment grade locations, and therefore they have a much lower median value, but they also have a much lower capital growth rate on the basis of the fact of the risk associated with buying those sorts of assets. Brisbane is very much a northern corridor and a southwest and a southeast corridor. So in terms of price point, we generally, as a business, only work with clients with a budget of $400,000 and more. The reason for that is that the locations that require a lower budget are not locations that we personally have a lot of agent networks in. The locations that are further out in a lot of greater Brisbane suburbs, and I've talked about this on podcasts with you previously, Phil, we don't buy out in the Ipswich area, nor do we buy in the Logan area. The reason for that is there is a lot of broad hectare land available in those two regions, as well as the northern parts of the Gold Coast City Council. And 85% of Southeast Queensland's future dwelling supply will come from that broad hectare land. So I see that as a longer term supply risk. And, there's suburbs right now that are at risk due to higher than average rental stress that are in those corridors. So Digital Finance Analytics recently published an article in the Australian Financial Review with the top 10 postcodes in Australia that have high degrees of rental stress. There were two locations in greater Brisbane suburbs that were within that list. Such a light city, if you like, out towards Ipswich, that was created a number of years ago, about 10 years ago. And there's a lot of brand new homes that were built, and it just keeps growing and growing. Now, 50% of renters in that location, according to Digital Finance Analytics, are currently struggling to pay their rent. The other postcode is Ipswich, postcode 4305, and 48.7% of people in that postcode are currently struggling to pay their rent. So, I guess for investors that are chasing cash flow, what we found with these two locations when we look retrospectively over the last 10 years is that there's been zero or negative capital growth. However, rental yields have continued to escalate. So what that means is that it's become more expensive to rent in these locations than it has to buy in these locations. So yes, it appeals to investors chasing cash flow, but the first wobble in the economy, and this is a significant wobble, let's all admit, if investors can't continue to pay their rent, then unfortunately that's going to impact on an investor's overall returns. And that's something that an investor needs to keep in mind if they are chasing that sort of strategy. I think also the opportunity cost of missing out on capital growth or having zero capital growth over a 10-year period is huge. And people need to understand the power of compounding capital growth. You make the most money with compounding capital growth in years, 10, 20 to 30 years. And it's about time in the market. Property is not the asset class to make quick money, and property growth is not linear, but it's about getting in as soon as possible and holding that asset for as long as possible and riding the wave of capital growth. And that's when investors will, get the maximum return depending on what their goals are over the period that's ahead of them.
So some really good points there, Melinda, and you've got quite detailed in some of those numbers. And I think you've articulated really well the fact that Brisbane is not a radial property market. And I think of Sydney. Sydney's like, how close are you to the beach or how close are you to the CBD? Yeah, it's very different. It's like a weird sort of spoke with a wheel there down in up in Brisbane, and there's a whole bunch of places that you don't want to be investing. Not to say they're not bad places to live, but we're talking about property investment here. And to your key point, you don't want your money tied up in a property that's not performing. So you don't put something into something that's not going to make you any money. That's not why you're a property investor. So you got to get that right. But you spoke about a lot of areas where you shouldn't be investing. So let's chat about, and this is to Matt's question here. Thanks for writing in, Matt. Can you please, if possible, provide hotspots that investors should look into as we start to move past COVID-19? Where should we be investing in Brisbane? You've told us where not to.
I have told you where not to. Look, we love the area, obviously, around the Petrie University. But again, there is a lot of flood impact, and that's in the lower part of the Moreton Bay region. I've spoken about this area a number of times on the Smart Property Investment podcast. And if you are in a lower price point, we believe the economic growth drivers in that area are huge because of the University of the Sunshine Coast precinct and the other development that's happening around that area. So there's pockets there that are just no-go zones. We do not buy in every location within those suburbs. And so it's understanding locations or streets within suburbs. There are some suburbs around that university precinct that have a lower demographic. So it's understanding the demographic of the area. And it's also understanding what that area is going to look like in the future, because there's been a lot of council changes recently that investors need to be aware of, because you don't want to be negatively impacted by future development. For investors with a higher price point, a higher budget, we definitely recommend coming in a little bit closer to the Brisbane CBD. Reports from the Brisbane Economic Plan show that the majority of new jobs between now and 2045 are going to be coming into the Brisbane CBD. And the second highest area for jobs growth is going to be the Australian Trade Coast precinct, which is around the airport and the Port of Brisbane. Now, we should know the Brisbane second runway is due to open in July, which is super exciting, except that planes aren't really flying at the moment. When we resume to some level of new normality, the prediction is that Brisbane will become the gateway to Asia for Australia. Now, that might seem like a bit of a distant dream right now, given what's going on around us, but COVID-19 is not going to be here forever, and we need to understand what Brisbane's potential is for the future. So we need to make sure that we're buying in locations that have good accessibility to the employment hubs. There's been a lot of commentary around people are going to change the way they work. They're not going to be going into offices and things like that anymore. Look, at this stage, that's all anecdotal. We don't know for sure that that's going to be the case. And it might be as the economy recovers, people just go back to what they know is the normal way of doing things. So, we certainly don't base our recommendations on speculative activity. We base our recommendations on what we know. And so transport corridors are critical. Brisbane has doubled its commute times by road in the last 10 years. And with the population growth that we've had until recently, until the borders have been shut, we don't see that the roads are going to become less congested. They're going to become more congested. So over time, that's only going to get worse. So if you're buying in a suburb that has no access to public transport, or if you're buying in a suburb that only has access to surface road transport, by that I mean buses, then 10 years from now, you might be in a bit of a black spot in terms of accessibility to those employment hubs. Another thing that I can't stress enough in Brisbane is about making sure you're buying in an area which has good school catchments. Some schools are enrolment managed schools. You can only get your child into that school if you are in the school catchment. Tenants will often pay a premium for some school catchments over other school catchments. So it's understanding the desirability of a location as well, and overlaying that with all of the investment parameters that we would look for when recommending a location for clients as well. So I know I haven't given specific suburbs because there's too many to list when you actually look at those drivers. But if you're targeting transport corridors, if you're targeting areas where there's a high proportion of owner-occupiers in comparison to renters, with good, high growing disposable incomes, good school catchments, and just a desirable lifestyle, accessibility to shops, cafes, and the lifestyle that we've grown to love here in Brisbane, then you're going to be putting your best foot forward.
And you mentioned some known unknowns that we have right now, as in how will Brisbane, how will Australia react to heading back into the office, and how that might shape employment habits moving forward. There's also some other more immediate economic factors, government stimulus. And there's a question here from Anonymous that says, when the government ends its JobKeeper and JobKeeper policies, will it have an impact on house prices and rental yields in the Brisbane area? Pretty generic question.
It is, and it's that really hard question to answer because, we don't know with certainty. No one knows with certainty what the economic impact will be at that time, let alone what the impact on property markets will be. What I read even just this morning is that we understand that a lot of property owners have taken out mortgage deferrals. And in fact, I've got a number here, 480,727 people have put residential mortgages on some sort of deferral for their repayments. Now, the Australian Financial Review this morning indicated that banks are already starting to contact their customer base to ask them if they still need that assistance. And some of that data apparently have been recorded incorrectly because up to 20% of those who requested mortgage deferrals never actually took them. And already there's, I know the the National Australia Bank have indicated that between 15 and 20% of all of those clients that put their properties or their mortgages on a deferral have already started to resume normal repayments. So it's not as bad as what you may have read in the media. The Australian Banking Association is working very closely with the banks. And as I read this morning in the Australian Financial Review, the banks have indicated that they're not going to force home owners to sell their property at the end of this period, and in fact that they may extend any mortgage deferrals into the rest of the year and right into 2021. So Australia's wealth is all encapsulated within residential property. That market is worth $7.2 trillion. So if the banks, have this requirement to forcefully sell properties, it's not going to be good for our economy at all. So it seems that all levels of government, banks, they're all working together to ensure that, there's not going to be this cliff at the end of the September period, which people have spoken about and people have reported about. In terms of rents, look, again, I think it comes down to understanding what's happening right now. And property managers that we've been speaking to across Brisbane have indicated that rental arrears are really low right now, no different to when it was before COVID-19 came into effect. We don't know with certainty whether that's because people are being supported on their incomes or not. But, certainly the spike in vacancies in some of these product types has already caused some run-on effect. So I think that if you already own investment properties in investment grade locations and you're targeting properties that are in areas where people typically have high incomes, then there's going to be less risk. It's all associated with the location you've selected or that you will select and the asset type within that location as well, because renters typically are looking at, renters that are on the pay JobKeeper and JobSeeker potentially right now. The industries that have been most impacted have been in the hospitality and the tourism markets. They're generally not the demographic that own property. So as renters, you've got to then understand, well, what type of product are they likely to rent? And what we've seen in terms of the spikes in vacancy in Brisbane, it's more likely that they've been in the higher density units in and around the inner CBD. I think coastal markets may be more impacted by delinquencies in rent after this period as well because of the risk or exposure to the tourism.
Yeah, well said, Melinda. And, it's a tough one understanding government stimulus packages and the need for them and how they're impacting or shaping people's buying. It's all about wealth effect, right? It's how wealthy do people feel at any given time. And when you look at some consumer spending numbers coming out, people have been pretty active on their credit cards recently. And I think there's a lot of people who are cashed up or feel cashed up as a result of JobKeeper and JobSeeker. They're probably earning more than what they did when they were actually in a job. But, we're getting back to business right now. What we do know is that, and the government's made it pretty clear, federal government, that they're not going to be extending these packages beyond September. Maybe for certain industries it might be different, but they're already unwinding some industries. Well, childcare, for example, and they're saying, well, everyone's back to work, you guys are making money again, you're all okay. So just be careful with shaping too much of your decision making on the stimulus packages available. But that said, there's a really good question here from Samuel, and Samuel asks us, Melinda, hi guys, I'm stuck as I am not sure whether to build a property taking advantage of all the grants and concessions to live in it, then invest, or whether to rent vest. So this is the Stimulus's home builder package, where you can build a place between 150 and 750 grand. I think I got my numbers right, and the government will pony up 50 grand to help with that. So a lot of people, and let's talk about this specifically within Brisbane, are thinking, well, I'll just build a brand new home in one of these maybe greenfields, greenbelt suburbs, and I'll get 50k in my back pocket as a result of it. What's your thoughts on that strategy?
Well, one, you can't be a property investor to benefit from that grant. So that's the first thing to keep in mind. So if you are a home buyer and you're looking to build, especially if you're looking to take advantage of those areas where you can purchase land and build a brand new product in a new estate, please remember that your capital growth will be compromised over the initial few years of holding that asset, because the land will appreciate at a slower rate than the building will depreciate. Now, what I mean by that is that when you buy brand new, there's a lot of margins that are built into that price. You've got a developer's margin, a builder's margin, every subcontractor's margin. There are so many hidden margins built into that price, and you're paying a premium because it is brand new. So yes, the government's incentivising that because they're wanting to stimulate that construction industry. A better bet might be to buy a block of land in an established location where you've got more control over what that neighbourhood looks like already, who your neighbours will be. You're able to still take advantage of those grants that are available, but you're in a land banked location. So you're not going to be in an estate where the developer simply releases stage 2, 3 and 4, and therefore your capital growth is compromised because of the future supply that's coming to an area. So I'm all for maximising the opportunity associated with these types of grants, and building brand new is a great strategy for home buyers that want to get into the market. But remember, it's the location of the land that's going to drive the capital growth value of the property, because the building itself will devalue or depreciate over time. So it's having an understanding of the locations that are going to deliver that long-term capital growth that I'd definitely be mindful of if you're going to follow that strategy.
Absolutely, and long-term capital growth is what us all want, what we all want as investors. And there's a question here from Stuart. Thanks for writing in, Stuart. He says, "Hello, Phil. I've owned a 4-bedroom, 2-bath, 2-garage house in Dacabin over the last 4 years, and I've seen little growth. Is there growth in the future?" And by the way, I don't know where Dacabin is or whether or not I've said that correctly.
You said it correctly. Dacabin falls a number of kilometres north of the Petrie University precinct, so it is in the Moreton Bay Shire. Dacabin is in an area where there is a lot of greenfield land around it. Dacabin, Burpengary, there's a lot of new estates happening in that location. So that runs off the back of what I just explained. When there is a lot of land available and when you're buying something that's new, yes, you'll get a premium rent for that property. Yes, you'll get depreciation benefits, but your capital growth may be compromised simply because of the future supply that's around you. And when you're an investor and you're buying a brand new property, and then stage 2 of that land release, comes out, your property is now second hand, and yet stage 2 are selling for the same price as what you've paid brand new. So, all of a sudden you've actually lost value in your property by owning it for 12 months. And I think the critical element there is understanding the area and the future supply that is in around that area.
Okay, there's a specific question here from Anonymous. Thoughts on the Redcliffe area?
Redcliffe on the peninsula. In fact, I read a study recently about Brisbane and the desirability of our coastal suburbs in relation or relative to the desirability in Sydney and Melbourne's coastal suburbs. And there's much less correlation in Brisbane between property price growth and coastal areas. Redcliffe is a long way from the CBD. The demographic is largely an area where a lot of people do go to downsize or retire. There's not a lot of economic activity itself at Redcliffe. There's not a lot of jobs at Redcliffe, so you do have to come off the peninsula to come back either into the CBD or into other parts of Moreton Bay. It is recently serviced by a train line, so you will have a train line from Kippering all the way through to the CBD. Honestly, it's not an area that we're currently investing in on behalf of clients, simply because of all of those factors. So we like to be closer to those employment and economic hubs.
Yeah. And I'm sort of familiar with the area. I spent a lot of time looking at Kippering to invest in that area at a point in time, just as that train station was going in. But you know, I think the key point here, and we made at the top of this this broadcast, Melinda, was Brisbane is different to Sydney and Melbourne. If I was thinking of the same location here in Sydney, a couple of streets from the water, it would be a very different proposition than what it would be in Redcliffe. So for those out of state investors, don't put your bias of where you live and the way you see the world in your own hometown into Brisbane. It is a very different playing field, and don't make those mistakes. Now, back to a point here from Talia, who was asking before about the price range in Brisbane. She also followed up with a supplementary question, is what is the best source or website you'd recommend to the starter investor wishing to seek distressed properties for sale? So I think Talia's already worked out what her strategy is. Is there a magic website that tells you where all the distressed properties are?
No, not a magic website. You can use search functions on realestate.com if you wish to search for divorcee sale or fast sale required, or you know, deceased estate. You can use search keywords on the major real estate platforms. To be absolutely honest, generally what we find is that if you are looking for distressed sales, either the public trustee has a listing site here in Queensland where you can log on and see any properties that they're looking after in terms of distressed sales. But a lot of distressed sales sell quietly. They sell off market. And the reason for that is that, you know, if people are going through a divorce or a separation, or, you know, there's been a death in the family, sometimes an easier option is actually just to offload that off market. And that's where, you know, aligning with buyers agents can obviously be to your advantage, simply because we are working directly with sales agents every day, and we do know when a property needs to be sold quickly. And if someone is distressed, they don't want to spend the additional money in bringing a property to the market and paying for photos and paying for a marketing campaign when they know they can offload that quietly. So it's probably becoming harder for buyers to access distressed sales if you aren't aligning with a buyer's agent. But definitely in Queensland, you can keep an eye on the public trustee site, because that's where all public auctions are conducted for properties that are distressed, or, you know, in the situation where they do need to sell through public trustee.
Yeah, my point on this would be just be careful of distressed properties, what the definition of distressed is. One person's distressed is someone else's not distressed, and just because something is distressed doesn't necessarily mean it's a good purchase. And I think a lot of people get that wrong, Melinda.
I agree. Absolutely, 100%. It comes down to, you know, not changing your focus based on, you know, the fact that something is distressed. If you know that you're looking in a certain area or certain streets within a certain suburb, don't lose focus on your primary strategy just to get something cheap, because cheap does not always mean better.
Absolutely, and I do that all the time when I'm buying stuff that I don't necessarily need. But anyway, quick chance for me for a quick plug. There's a question here from Jim. What are some of the free resources available to investors looking for useful data on the Brisbane property market? Core Logic is a little expensive for new investors. You've got to pay for good data, so don't be scared to put your hand in your back pocket, because you know you've got to pay for good stuff, just like a distressed property. But Jim, go to smartpropertyinvestment.com.au, click on the data tab. You can search every suburb in Australia, houses, units. There's census data, there's geographic data, there's everything you need to help shape the way in which you're looking for property. But spend money if you want to make it. It's a big purchase decision. Don't scrimp on data. It's a good question here, Melinda, from Anonymous. What will make Brisbane perform better than others, and I guess other capital cities? It's always been affordable. It already had lots of interstate migration, but it always underperforms.
Yeah, I'm just going to bring up a graph which just might help to explain and answer this question. So I've got median house price by city that's coming up. Now, what this shows is 3 points in time, which help us understand how Brisbane has performed in relation to other property markets around Australia. So the first area that I've highlighted there is back in the recession of 1991. Now, the price disparity between Brisbane and the other capital city markets at that time is not as high as it is today. So clearly something's been different in Brisbane. And this is why, we've seen this change over time. So during that recession of 1991, in fact, the Brisbane property market increased by 6%, remained flat, whereas the Melbourne property market decreased by 6% across the same recession period. And I think that highlights the fact that it's local drivers of supply and demand that impact property values the most, as opposed to the macroeconomic environment as a whole. Now, obviously, we're in another recession now, which we'll get to. And if we just have a look at that graph again, because that next section that I've highlighted is in the September 2011 period. 2011, of course. And that's when we had the Brisbane Flood, in January 2011. And this was a significant event for Brisbane. And what it did is it caused a 2-year decline, or flatline, if you like, of price growth in Brisbane. Now, we saw some properties clearly decline in value as a result of the significant impact of inundation, but we also saw our economy suffer significantly. Now, that was not an impact that had any significance on Sydney or Melbourne. However, it did have a significant impact on Brisbane. So this is another example of where local incident or local things can actually impact on property markets. Where we are today is that we've got this large price disparity. Now, why Brisbane hasn't seen the same price growth over the last 10 years as the likes of Sydney and Melbourne is largely due to the supply and demand metrics associated with our city. So we've had a recent change in our city plan back in 2014. And since then, we've seen a significant amount of redevelopment, especially in our inner city locations. And that's as a result of zoning changes for land. And a lot of developers came in and built much higher density unit stock. That hit its peak in 2016. And as a result of that, we not only saw some vacancies in the unit market, but that trickled down into the housing market. And it has an impact on property values as well, because when you've got more supply than you do demand, it causes property value softening. So we're now moving into a period where the number of building constructions has significantly declined from its peak. In fact, we're at 85% of its peak, of our peak back in 2016. So we've got construction commencements declining, we've got building approvals declining, and we're moving into a position where our future supply is looking really limited. Now, obviously, from the demand side of things, we've got to look at the things that are impacting on the demand for property. Now, throughout the worst of COVID-19 and during the recovery over the last couple of months, our market has been seeing huge demand again from owner-occupiers. Investors have largely been sitting on the sidelines, but they are starting to come back, and we've certainly seen a resurgence over the last 2 to 3 weeks. Now, the owner-occupiers that were in the market prior to COVID-19 have simply been sitting on the sidelines waiting for some more certainty, and now they're back. So demand has continued to escalate and accelerate over the last couple of months, certainly since about Easter. That's when we started to see the buyers re-enter the market. In terms of the sellers, they've only really started to come back into the market over the last 4 to 6 weeks. They are not distressed sellers from all accounts of the interviews that I've been having with agents across Brisbane. They're simply sellers that have had their plans on hold, and they've chosen to bring their properties to the market now because they had already planned to do that, in March or April, but they put their plans on hold. So I think that when we're talking about why has Brisbane, not performed as well as Sydney and Melbourne, it's always been more affordable. It actually hasn't always been more affordable. And in fact, when we look at that graph that we saw previously, we can see how that price disparity has rapidly escalated over the last 10 years. When we consider the percentage of household income that's required to service a new 80% loan to value ratio mortgage, in Brisbane, that's about 30%, which is well within the level considered affordable. Compare that with Sydney, which is 47.3%, and in Melbourne, it's 34.3%. So Brisbane has actually become more affordable over the last 10 years because our price growth has not moved as much as our income growth has. So it's all relative to understanding, how easy it is to access money now. And admittedly, we're in a time where a lot of people are struggling to get money, but there's a huge portion of buyers that are having no problem getting money, and money has never been cheaper because interest rates are the lowest that they have ever been. So there's a lot of buyers that are cashed up, they've got their pre-approvals in place, and they are ready to act. And that's what's driving the demand up in Brisbane at the moment and supporting the growth that we've got, the lack of, decline in values that we've experienced.
Okay, Melinda, I'm conscious of time. I've only got a couple of minutes, so I'll get you to answer this question really quickly, and then I'll get to our final discussion point. This is from David. I know, David, you've been waiting patiently for us to chat about this, so thank you. He asked, you're talking about Brisbane. How about the coast and out to Toowoomba? What are your thoughts? Quick answer. I don't
deal a lot in the coast and out to Toowoomba. They're talking about a city deal in Brisbane that's going to connect all of southeast Queensland from Toowoomba to the Gold Coast, Brisbane and the Sunshine Coast. If that gets across the line, I think that it's going to be more positive for those markets. The coastal markets right now, I feel, may be more impacted in the future simply because of the impacts to tourism, and people a lot of the time come to Brisbane and they go to the Gold Coast or the Sunshine Coast for their holidays. Once the state borders reopen, hopefully those markets will pick back up and there will be less downside risk. So, we only work within the Brisbane market, being a capital city market, being the main economic hub of Queensland, and therefore that's the market that we specialise in.
Fair enough. Okay, so you haven't been too specific with any location, so I'm going to finish with this one, and I'm going to pin you down to giving us some location. This is from Nalin. Thanks for writing in your question, and it is, if you have $500,000 to invest and looking at capital growth over the next 10 years, where will you invest in Brisbane?
Well, I think that depends whether you need to have a neutral rental yield as well, or whether you can afford to hold a property with negatively gearing in place, because my answer would be different depending on the answer to that question. If you need a fairly neutral yield, then I'd be looking in very specific pockets around the Moreton Bay region, around the Petrie University precinct. If you are happy to hold a property and potentially have a slightly lower yield, the capital growth opportunity may be slightly higher in locations a little closer to the CBD, Capera, Geebung, Oxley. There's a couple of locations. It's very hard to get in at that price point right now. And generally, those properties will require some form of improvement or renovation as well. But look, investment grade locations, I don't like to give away all of our secrets because our clients pay us for the knowledge that we provide. But there's definitely a lot of locations, and it's dependent on the individual investor as to how we'd actually recommend them, which locations we'd be recommending.
Okay, final question. Is it the right time to buy now? Obviously, you're going to say yes, but how do you make that decision?
Well, I think that the answer does depend on the individual, because for some people, the right time's not now. I think that there's clients that we put on hold during the worst of COVID-19 and because there was too much uncertainty. And, we've still got 2 clients that are on hold because their risk appetite is simply not at a point where they're happy to move forward. So I think that what I'm saying to people that contact us about whether now's the right time or not, if you're prepared to pay more in 6 or 12 months' time, or prepared to move one suburb further out in 6 or 12 months' time, if the market shifts upwards based on the current supply and demand metrics, then you're happy to wait, then that might be the right decision for you. Alternatively, if you're going to be concerned if the market shifts backwards in the next 6 or 12 months, and therefore you're going to regret that decision, then you need to hold off as well. So if either of those things are not a concern for you, property is not about the returns you're going to make in the next 6 or 12 months. Property is actually about buying now for 10, 20 or 30 years from now. And because I believe as the economy continues to improve and all of the restrictions continue to be lifted, I think demand is going to continue to escalate, and it's going to be harder to secure investment grade properties. We're already experiencing multiple offers at the moment. So if you're prepared to be in a more competitive environment, then, waiting, if that is what your risk appetite determines, might be the right thing for you. But if you're a bit less concerned about risk, getting in now, positioning yourself for 10 or 20 years from now, there may never be a better time.
Well, it's a very sage counsel, Melinda. And how can people, if they want to have a chat with you guys, how do they get in touch?
Visit us at streamlineproperty.com.au. All of our contact details are on our website. They can email directly info@streamlineproperty.com.au, but we're available. We do offer a 15-minute discovery call for anybody looking to investigate whether working with us might be for them or not. It's completely obligation free, but I conduct those calls myself. So I'd love the opportunity to speak with anyone that's interested in chatting further about Brisbane.
Well, you obviously know a lot about Brisbane. I'm really impressed by your detailed knowledge, and I guess that's one of the benefits of someone that just concentrates on one particular location.
Yes, that's been our philosophy since we've started the business. I've grown up in Brisbane. I've seen Brisbane change from, when I was a toddler, and, I can also see what Brisbane's going to look like in the future on the basis that I'm a property developer as well. So I understand the city planning scheme, and it's not just about what might be sitting on a block of land now. It's about what is the capacity of that land in the future. And that really, it needs to be considered if you are a property investor, because it's all about, understanding what the value of that property will be 10, 20 or 15 years from now. So
very good. Well, thanks for your time today. I really always enjoy catching up. I always feel a lot more informed after it. So I'm going to take away a lot of these numbers now, and I'll include them in my normal patter on my podcast. So thank you so much, Melinda.
It's been great. Thanks for having me, Phil. I hope that people have got some valuable information out of today.
It's good. That's Melinda Jennison from Streamline Property Buyers. Go and connect in with them, have a chat, see what's going on up in Brisbane, and I hope you enjoy it. Thanks so much for everyone for tuning in today to Smart Property Investment Live. We really do enjoy these type of discussions, so we'll keep the chat open for a little bit longer as well. If you want any questions at all, put them into there, onto the little box next to where you're watching to this right now, and we'll make sure we get them up to Melinda and we'll get them answered as well. We might even do a podcast around it as well, some of the questions that we haven't got around to Melinda at a point in time. That's it from us today. I hope you've enjoyed spending the last hour with us talking about the Brisbane market, and to all those people that normally go out there giving me a hard time saying that we only talk about Sydney and Melbourne, there you go. There's a full deep dive 1 hour into Brisbane. Watch this space. We're going to look at the other capitals as well as Sydney and Melbourne, where there's a lot of activity. We'll be back again next time. Until then, bye-bye.